Hello and welcome to It's Your Business with Mario Toneguzzi on Megapix Media. Joining me today is David Yager, who is author, writer, and an energy policy analyst in Calgary. Thanks for joining us today, David.
Oh, thank you for asking.
Well, we've had some huge news in the oil patch in recent days. Let's start off with the Cenovus and Husky deal. First of all, were you surprised by that taking place?
I wasn't surprised that Husky disappeared or that Husky changed its hands. They've been telegraphing for almost 2 years that their enthusiasm for Canada was diminished. They had tried to do the Meg Energy transaction that didn't work. They were very disappointed with curtailment. All the integrated companies were. Suncor had gas stations and refineries. They didn't like it. Imperial did that. Husky wasn't happy with that. So I hear through the investment banking community that Husky has been quietly looking at ways and this is an interesting way to do it, because how do you do a transaction when your stock is at an all-time low because of COVID and the oil price? Well, you take shares of another company that's in the same boat, right? And in the same way that if you were stuck with your Husky investment and you were waiting for better times for it to recover, you can do the same thing now, except that they put it in a structure where, because of the synergies and the consolidation and a bigger company, they can still participate in the recovery of their equity value, in perhaps a more efficient way than doing it on themselves. The other aspect of that company in itself was it did have a controlling shareholder in Li Ka-shing and Hutchinson Whampoa, and often listed companies with a controlling shareholder trade at a discount, and that takes that particular shareholder and dilutes it significantly. That takes them from closer to 50% to something in the 20% range. And that also helps improve value. So if you're, in a way, for Husky, this particular transaction, as for Cenovus, they wanted to dilute their debt over a larger asset base, and this seems to meet their criteria. So again, the Husky participation didn't surprise me. Who they were going to dance with, that of course was unknown till Sunday.
Now, the unspoken thing about about this is obviously the impact this is going to have on jobs out there. We haven't received yet word on specifics, but when you see something of this magnitude, and you've seen other deals in the oil patch in the past, how many people? What does your gut tell you of how many jobs will be lost in this?
People don't understand, but the first person to lose their job is one of the people that signed the deal. It's true. By nature, 50% of the C-suite is gone. One of the CEOs is gone. One of the CFOs is gone. One of the COOs is gone. So in terms of percentages, it actually starts at the top. Yeah. The assets owned by Cenovus and Husky are not overlapping particularly. If you look at the East Coast offshore and the South China Sea, the upgraders, Cenovus has an interest rate. So at the other end of the employment pyramid at the field level, the people engaged in the assets are their jobs are secure. I mean, the point is you got to keep your plants running and your wells running and your facilities running. So those are the two extremes: 50% job loss at the top, probably very little, if any, job loss at the bottom. The question is the SG&A, the sales general administrative is what we call it in the trade, is the go down the pyramid. And so there's obviously some opportunities to make the combined entity more efficient. At the head office level is the obvious place, and the administration level. So it sort of cascades down. There's a news report of something in the 20 to 25% range. I don't know of total employees. I don't know whether that is aspirational or practical, but hopefully they'll do this often, because this was a friendly merger. Combination appears to be friendly anyway, because of the nature of it, instead of a hostile takeover. Generally, if it's an unsolicited bid or a hostile takeover, the acquirer keeps its team, and the people on the other side tend to be persecuted, or at the top of the dismissal list. In this particular case, what I'm hoping will do they'll do is they'll just go through both organizations and pick the best people for the job. And I don't know, the level of redundancy is unknown. The figure that they put out, I saw in a news report today, was something in the 20-25% range. That seems high to me. That may be the aspirational number early in the stage to attract investor interest. We'll see what goes. But certainly at the field operations level, everybody's got a job. They got to keep the lights on, they got to keep the oil flowing and the gas stations pumping fuel, et cetera, et cetera, et cetera. So there'll be no impact at that level because of the low amount of joint ownership at the operations level.
Yeah. The other big piece of news that came out here yesterday actually was Suncor consolidating offices in Ontario and moving here to Calgary, those offices. What are your thoughts on that?
I think Suncor, it was time, this is a little political. I mean, first of all, there was back in the day, you and I are old enough to remember, there was a time of head office consolidation in Calgary when Imperial Oil moved here and TransCanada moved here and CP Rail. So the idea that you would leave a higher cost center like Central Canada, Toronto, or Montreal, move to Calgary, I mean, people did that because it was more efficient financially. The timing of it is such, and I'm not so sure that Suncor isn't trying to throw the premier a bone here. In a way, I mean, they're looking at ways to. I'm told internally that the announcement that Suncor made a couple of weeks ago was hard on them, if you will. They were trying to develop a culture, and Suncor was trying to develop a special place to work, and then reality loomed its ugly head, and they had to do what they had to do. And so I think this is maybe a way of saying to. Saying to the head office people and maybe saying to their fellow Albertans that, we're not as mercenary as we look. We're looking at ways. This is sort of interesting in the sense that it probably results in net job loss. What I mean by that is often certainly was the case going back when head offices were moving here. I cited 3 examples. A lot of people said, well, we want you to move to Calgary. And a lot of people were terrified at that thought. Calgary, oh, good God. Do they have quiche? I remember one guy said, do they have quiche in Calgary? Can I get quiche? I mean, there's a lot of Central Canadians that still think this is the rough and tumble Wild West. So I'm not sure everybody's going to want to come. So that'll help on the job side. But it's good. I mean, it's finally, this would be in terms of downtown head office space in the oil and gas industry. That might be the first reversal of the vacancy rate we've seen in some time.
Yeah. And David, one last thought, just as you look at the oil patch right now in Alberta, what are your thoughts on, is there any end in sight to the struggle that this industry is going through?
The gas side is really looking promising. The joke I make is yesterday's zero is today's hero. The spot price for gas is over $3. We finally got that Nova expansion announcement, made its way through cabinet. The LNG Canada is still soldiering on. The spot price for gas is at $3. The average price for gas this year is materially higher than it has been. Gas has powered this basin before. Something like the rig count snuck up to 99 on Friday, and almost half the rigs were drilling for gas again. And so gas was out of the game. Gas is great. It's not persecuted by the climate side so much, and there's lots of it here. On the oil side, I think it's really the cash flow. You can only take. The thing is in the oil sands, the joke we made, or in the oil business, the joke we made in the 1980s about oil companies was a grocery store is quite profitable if you don't restock the shelves, but you don't last long. And an oil and gas company with declining reserves is in the same boat. They can take a short period of time off, but they can't take forever off before they have to get back with reserve replacement. So I would say that there's two things that drive activity. And activity defined as when are we going back to work? I mean, that's the fundamental question. What's going to happen in the big picture is there's 2 things you need: is cash flow and confidence. So the cash flow on the gas side is actually up. This doesn't get much press. Oil is still challenged. There's another another drop in oil prices going on because Libya's brought some production on and COVID's doing this. So the cash flow is actually improving from gas, although that's, it's some material for the gas producers. But the other is confidence, and confidence has been elusive. For example, just the other day, they prorogued Parliament. Now we're going to have another election. And then they dodged the bullet there. So these are confidence crushing. Now we've got the American election on Tuesday. What does that mean? What is Biden going to do? So to get back to work, the producers have to quit worrying, focus less on their future and more on their assets. Like they're focused on their balance sheet. They're focused on survival. What curveballs are going to come next that are going to muck this thing up. And the U.S. election might be the last. They had this election in Saskatchewan. That's fine. That's clear. BC looks more benign than they did a couple of years ago, so that's clear. Alberta is what it is, so that looks okay. Ottawa would appear to be outside of the clean fuel standard, which is still a ways down the road. They don't seem to be cooking up any more ways to muck things up for a little while here. And so we'll get the U.S. election over next week, and maybe folks can look around and say, well, what you see is what you get, and have the confidence to go back to work. Cash flow is still restricted. It's actually really terrible. But as the cash comes in, what are they going to do with it? And when they have confidence, they'll invest it. And when they don't have confidence, they'll pay down debt.
Yeah. Okay, then. All right. Well, thanks a lot, David, for joining us today.
No problem. I hope that was helpful. It was my favorite subject. Thanks for asking.
Okay, that was David Yager, who is a author and a writer and an energy policy analyst in Calgary. This has been It's Your Business with Mario Toneguzzi on Megapix Media. Thanks for joining us today.